Well, moving right along, let's take a look at Chapter 3, Adjusting Accounts for Financial Statements. This time, let's look at the algorithmic version of Quick Study 3-21. So the problem reads, the ledger of my company includes the following accounts with normal balances. Prepare the necessary closing entries from this December 31st year-end information. Okay, and they tell us the ledger accounts with normal balances: common stocks 10,600, dividends 1,600, service revenue 29,000, wages expense 16,400, and rent expense 4,800. So we're going to prepare closing entries. Now remember, there are 4 closing entries. The first closing entry, as it says here in the prompt, record the entry to close the service revenue account. So remember, we're going to close out the revenue account balance, and it's getting closed to which account? Income summary. Hopefully you got that down now. So we're going to close the revenue account out to income summary. So revenues have a normal ending credit balance. To get rid of that service revenue account that has a ending credit balance of 29,000, they don't tell us this, but we should know by now that revenues have normal right side balances or ending credit balances. So we want to make that 29,000 credit balance go away. So how do we make it go away? Well, we're going to give it a debit. So we're going to debit service revenue for 29,000. So that's our first entry. We're going to debit service revenue for 29,000. And we're closing out this account to income summary. So in the transaction, what's going to be the credit then for the closing entry? Well, we debited service revenue to zero out that account, and now we're going to post that to income summary with a credit. Okay, so that's the first one. Now let's go to the second part of the closing process. The second part, as the prompt says, is to record the entry to close expense accounts. So we close all expense accounts. These are temporary, aka nominal accounts. And so we're going to close them out. And all expense accounts have a normal debit balance. And we have 2 expense accounts that are involved in this problem: a wage expense account and a rent expense account. Now these accounts have a normal debit balance. So let's look at wages first. Wages has a current debit balance of 16,400. It doesn't say that it has a debit balance, but by now we should know that wage accounts, expense accounts, have a normal debit balance. All expense accounts have a normal debit balance. So we want to make that debit balance of 16,400 go away. How do we do that? We're going to give it a credit. So we're going to credit wage expenses for 16,400, and that'll make that account go away. Now, notice that I left the first line empty. We're going to be closing all these accounts out to which account? What's the account we close expense accounts to as part of the closing process? We close them to income summary. So we can actually go ahead and put in income summary. But we can't put in the dollar amount yet because that'll be the total of all the expense accounts that we're crediting. We'll come back to that in a second. Okay? So let's move to the second account. We know we're going to have involved rent expense. Rent expense, like all expenses, has a normal debit balance. This debit balance, $4,800. How do we make that debit balance of $4,800 go away? Well, we're going to give it a credit entry for $4,800. And then with that, we have closed out both of the expense accounts now mentioned in the problem. Our last part of the journal entry is to put the total debit into income summary, and it's simply just the sum of wages expense and rent expense. So let's get the calculator out. We have 16,400 plus 4,800. So altogether, we're going to debit to income summary 21,200. So let's do that. And make a note of what that dollar amount was, 21,200. I'll do the same. Okay, let's move now to the next part of the closing process. Step 3 is to record the entry to close the income summary account. Okay, so the income summary account needs to be closed out now. It has 2 transactions in it. It has the credit for the revenue account. When we close the revenue account, we move 29,000 as a credit into income summary. And now when we just closed these expenses, we brought a debit into income summary of 21,200. So what would be the balance in the income summary account after we take the smaller one from the larger one? Well, we said we had a $29,000 amount as the credit. That represented the revenue. Subtract out the smaller amount. We know that was $21,200. That was the total of all the expenses. So then income summary actually has a balance of $7,800 in it right now. Now we want to close that account out. Remember, that's going to be a credit balance in the income summary anytime the company had a net income. So we had revenues less expenses, and it shows a credit balance of $7,800. How do we get that $7,800 balance to go away? Well, we're going to give it a debit entry for $7,800. So we're going to debit income summary for $7,800. And as you recall from the Learn Smart modules, hopefully, when we close out income summary, we close out income summary to which equity account? It's not common stock. What's the other equity account? Hopefully you said retained earnings. And if you did, that would be correct. We're going to close income summary out now, finally, to retained earnings by giving it a credit for $7,800. Okay? So for that one, you had to recall a couple of things. You had to be able to recall what the entry was to close revenues, what the entry was to close expenses, and then what the ending balance would be after those two entries in the income summary account. And now we're closing out the income summary account itself. So let's move on. Very last entry, very last process of the closing is to close out the dividend account. So let's take a look at the data. It says dividends. There were $1,600 in dividends. Now dividends, like expenses, have a normal debit balance. So there is a debit balance of $1,600. We want to make that account go away because dividends are also a temporary or nominal account. How do we make that debit balance of dividends for $1,600 go away? It doesn't say that that's a debit balance, but we need to know by now that dividends carry a normal debit balance. Assets have debit normal balances, expenses have normal debit balances, and dividends also have normal debit balances. So we need to make that debit balance of $1,600 go away. What are we going to do? Well, we're going to credit the dividends account for $1,600. And what are we going to close the dividend accounts to? We close this directly into retained earnings. So we're going to give a debit to retained earnings of $1,600. And notice we debit retained earnings. Do you recall what the normal ending balance was for retained earnings? Well, hopefully you recall it has a normal credit balance. So what's the effect that dividends have on retained earnings? Well, if we debit to close out dividends, it must be lowering retained earnings. And that's the exact process. So let's record this entry. And then let's check our work. And we received perfect scores on all of these, so congratulations. Hopefully you followed along, and let's just do a quick review. So we're closing out, and there are 4 steps in doing closing entries. The first is we're going to close all revenues to income summary. We're going to close all expenses to income summary. Step 3, we'll close income summary directly into retained earnings. And the last is close out the dividends account into retained earnings. Recall why we're doing these closing entries. Because revenues, expenses, and dividends are all what kind of accounts? Temporary accounts, temporary or nominal accounts, whose balances don't transfer from one period to the next. They need to zero out so we can start tracking revenues fresh for the new period, expenses fresh for the new period, and dividends fresh for the new period. So just recap with me, what type of balance do revenues have on their own T account? Well, they carry a normal credit balance, so to get that credit balance to go away, we must debit it for that same dollar amount as the total to zero the account out. So here we know that there were revenues of $29,000, and we're going, oops, I just lost the worksheet, sorry about that. There were revenues of $29,000, and since that is a credit balance, in the closing process, we debit revenue, and then plug income summary. Expenses, well, expenses have a normal debit balance. Remember the acronym ADE, assets, dividends, and expenses all have normal debit balances, ADE. So since these expenses have a normal debit balance, to get those balances to zero out, we have to credit them. And then we do the plugged income summary. Then we have to close that income summary, and since there was a $29,000 credited income summary and a $21,200 debited income summary would have had more on the credit side, $7,800 left on the credit side. To get that credit of $7,800 to go away, we had to have debited income summary for $7,800 and zero that out as well. This leads us to realize now that income summary, like revenues, expenses, and dividends, is also a temporary or nominal account. And we move that balance into retained earnings. Finally, let's close that dividends. Remember the acronym ADE, so dividends have a normal debit balance. To get that debit go away, we must credit dividends. We know that dividends were $1,600. So to make that amount go away, we credit dividends, zero out the dividends amount, and post it to retained earnings. So a lot of information here. This is a hard problem. Take some time.